In a world of information overload, in a world dominated by biased pay-to-play advertorials, in a world riddled with fraudsters, fakes, and phonies, one voice stands out to provide reliable information to investors, business owners, and busy professionals, unbiased and beholden to no one. This is Financial Poise Radio, the spoken word sister of FinancialPoise.com, the internet's most trustworthy resource about finance, investing, business, and law.
Hello, everyone, and welcome to Financial Poise Radio. I am Christopher Cahill. In a few, we'll be speaking with Dan Rossen, who is senior broker with CRC Insurance Services Incorporated. Yes, insurance. Don't click off. No clicking. Don't do that. Dan is a clear and compelling speaker who manages to suggest how some insurance coverages abet business growth, which is distinct from insurance coverages that merely protect businesses from catastrophe. But first, music to the ears of a bankruptcy attorney. In a recent Wall Street Journal, that is May 21st, 2016, page B3, the headline is S&P says debt load is rising. Woohoo, says the bankruptcy attorney. While the total amount of cash and other investments on the books of non-financial U.S. companies rose by 1% last year to $1.84 trillion, that's good for business, for long-term business health. Meanwhile, total debt grew at roughly 15% to $6.6 trillion. That's bad, or it could be bad. At least it portends ill, especially if interest rates go up, which they evidently are going to be doing. But the contrast between cash rising by 1% and debt rising by 15% is actually masking a bigger contrast, because the top 25 cash holders, that's 25 companies that hold cash, which are about 1% in number of companies in this particular classification, control more than half of total cash. Or 51%. 5 years ago, that portion was 38%. We're talking about Apple, Microsoft, Alphabet, the owner of Google. So the top 25 cash holders are doing quite well. They have a cash to debt ratio of 153%, and their cash grew by 8% in 2015. You look elsewhere, leaving aside the 1% corporate population. So the 99% hold approximately $900 billion in cash and $6 trillion in debt. That means that the cash to debt ratio for the 99% of companies is at 15%, way lower than the 153% of the top 25 companies. And that cash to debt ratio is the lowest it's been in the past 10 years. It's at 15%, it's only slightly above the 12%, which characterizes speculative grade companies. What's going to happen if interest rates rise? That cash to debt ratio is bound to get worse. One way that could be addressed is by changing the tax laws to encourage companies to repatriate cash that sits outside the United States. I'm not so sure how much that would help the 99%, but it undoubtedly would help. Moving along, even though as a bankruptcy attorney, I'm very cheered by that article. I can understand how others might feel otherwise. Let's move along to business transition and exit planning. That's one of the websites in the Financial Poise group of websites. It's devoted to the sales of businesses. And the b-tep site has recently published an article called Got a Company? Need or Want to Sell? How to Find the Right Buyer for Your Company. And there are some people out there who the owner of the business is unable to find an heir to take the business, or it's just time for retirement and there is nobody in the family to take it over. So comes time to sell, not because you're insolvent, but because you gotta. And this reminds me that in an earlier episode of Financial Poise Radio, episode 13, Jerry Mills, who wrote a book on business transition and exit planning, spoke at length about the, quote, baby boomer tsunami, end quote, that is boomers owning companies and reaching the point at which they need to sell. That's about now, so there should be a lot of companies for sale. That's an empirical question. I don't know the answer. Maybe he's right, maybe he's wrong, but it was a very interesting interview. Okay, let's talk about BS. That's right, science and BS. We're saying BS instead of the word it stands for because my producer won't let me say that word. But throughout the literature I refer to, the word is used. And what I'm referring to is an article by Brian Earp called The Unbearable Asymmetry of BS, published in Quillette, Quillette, February 15, 2016. And I also refer to two books by Harry Frankfurt, an American philosopher. One is named On Truth, published in 2006. The other is named On BS, using the real word, of course, published in 2005, because I think it's worth preserving a distinction between lying and BSing. Well, Earp talks about a peculiar scientific oddity, that is, an oddity within science research. Now, science, especially social science, has suffered from sloppy research, small sample sizes, major findings that turn out cannot replicate, and this includes economics too, by the way. And so science has been creating its own problems. Well, there's publisher pressures, there's celebrity journalism, there's a 24-hour news cycle rewarding flashy results, which helps lead to these defects. But Mr. Earp is talking about another defect. Mr. Earp poses a scientist named Lord Voldemort, who has created a controversial medical procedure, let's call it X. And X is a matter of some controversy. Some people don't think X is justifiably risky, and they think it might be unethical. But what is the Lord Voldemort to do? Well, a 4-step process is posed by Mr. Earp. First step, scan the scholarly databases. Second, if one sees a report of an empirical study that does not put X in a good light, then Voldemort will dash off a letter to the editor of the scientific journal, attacking the report on some grounds or another. Letters to the editor are not peer-reviewed. They are just printed. And now that letter to the editor has become part of the published record with every appearance of being a legitimate critique. Time goes on. Many letters have been written by that scientist or his friends. And the next step is to write a systematic review of the relevant literature at the end of a period of time. So Voldemort writes it, and this review rejects all of the studies that do not support his position as being flawed or refuted by experts through the aforementioned letters, which cite each other. And there you go. You've managed to warp science. Okay, that's interesting and a little troubling, but what also bothers me is that I'm not sure that's BS, because the name of the article is on the asymmetry of BS. I think the difference between truth and BS is very important in evaluating the claims of especially journalists and science being reported in journalism, including financial journalism. And that's why I refer to Harry Frankfurt, who wrote the book on BS and wrote a book on truth. For him, the difference is that someone who tells a lie has access to the truth, whereas a person who is BSing does not require any knowledge of the truth at all. The BSer is indifferent to the truth. The BSer simply wants the reputation for knowing something about the proposition at hand. The liar subverts the truth regarding the proposition at hand in order to gain some end. And that might be what Lord Voldemort is doing. He recognizes that there are problems with X, but he wants to benefit from X. Perhaps he has a financial interest. And so Lord Voldemort subverts the truth. I suppose it's possible that Voldemort really doesn't care and he's just BSing. But I offer this to you. Lying may be the honor that vice gives to virtue because it recognizes the value of truth. So, on the subject of truth, let's turn to the truth of insurance. We're speaking here with Daniel H. Rossen, JD, CPCU, who is Senior Vice President and Senior Broker with CRC Insurance Services, Inc. Dan earned his JD from Indiana, but has been making his way by helping insurance companies provide solutions for businesses. Dan, glad you're here.
Thank you very much. Pleased to share my thoughts on the insurance world.
I should mention that a larger version of Dan's biography is available on the Financial Poise Radio website, which is on financialpoise.com. Okay, I said CPCU. What is a CPCU, which you are?
CPCU is the designation for underwriters and insurance professionals, chartered property casualty underwriter, which involves a series of 10 tests that really acknowledges the industry knowledge of many, many subjects in the property and casualty insurance field. And earned designation that's a combination of 10 tests when I took it, as well as minimum years of industry experience.
Well, that's directly pertinent to the first question I'd like to ask, and I'm going to be a little verbose and then ask you to answer. Because somebody gets into business, might be a genius at a certain kind of IP, or somebody might, through marriage or inheritance, become a new owner of a closely held business. And suddenly they're owners, and they have a business that they're responsible for. And it's likely that somebody like that might not know what he don't know, to borrow an old phrase, or to use a newer phrase from then Defense Secretary Donald Rumsfeld. There's probably a good deal of unknown unknowns for such a person who's faced with these new responsibilities. You've had to learn about all sorts of unknowns, I think. So I guess I'd like you to comment, if you would, on some of the chief things that are really unknowns for such businesses that might cause pain to an owner or investor. What insurance coverages should investors ask about or know about?
Yeah, that's definitely a great place to start. I look at business insurance as a fairly dynamic field, and unfortunately many business owners ignore a formal review of their risks and insurance policies. And what I recommend is working with your independent insurance agent to go over all of your policies, make sure that the coverages for the exposures you have today are properly covered. There's a lot of emerging risks in the world that didn't exist even 5 years ago that have pretty efficient insurance coverages available, and it's a good idea to take an inventory of those coverages for any business owner, whether you're an existing business owner, new business owner, or even an investor in a business, to make sure that there's a proper portfolio of insurance coverages available for that business. Most business owners are aware of property insurance and liability insurance. In fact, those are the coverages that are usually demanded by a third party. So if you have a loan on your building, for example, the bank is going to insist that you have insurance. If you're engaging in contracts with a government entity or other businesses, they're going to want to get a certificate of general liability insurance. Those types of insurances are pretty standard in the marketplace today, albeit the pricing can be very flexible depending on the market trends. So it's always a good idea to shop those on a regular basis. I wouldn't say every year, but certainly check in with your agent to make sure you're getting the best possible price. But what we're seeing is really an evolution of new exposures, and the insurance industry doing a decent job at responding to those exposures. Things like cyber liability, where a small business, closely held business, might not be concerned about that because they outsource credit card processing to third parties or website hosting to third parties. But the concern is, what if those third parties that you're relying upon break down and that liability falls squarely on you as a business owner? You've got notification requirements from the FTC and various fines and things that could actually be insured. Another emerging trend is employment practices liability. That's, again, if your employees allege of untoward treatment to them through their employment relationship, but that can even extend to contractors and other people that are in a quasi-employment relationship. So again, dollars for exposure, those are good coverages to consider. The other point to look at for closely held business or businesses that are looking at investors, are you handling other people's money? So if you're a real estate manager, hey, I'm going to manage some apartments for a friend of mine as their managing agent. Well, you have a professional liability exposure that you're taking on from handling money of others. The last item I might mention in terms of the inventory is even a privately held company with investors has a directors and officers liability exposure. If owners or investors become disgruntled, many boards, even of private companies, are going to look to have some D&O coverage available. So those are just a few of the coverages that are important for a small business owner or investor to take an inventory of and evaluate. And of course, with an agent, they have a duty to go through those with the business owner in terms of covering the basic exposures and risks in the most effective way.
Talk to your agent and explore issues with your agent, I guess, is maybe a high-level kind of nostrum.
I think so. I mean, I work with agents across the country. I'm a wholesale broker, so I sell to agents, and there are some terrific agents out there, and there's some complacent agents out there. And, if your agent isn't suggesting you do that checkup, it might be a good idea to get a second opinion. I'm an advocate for selecting the agent that you have trust in and like, rather than allowing agents to bid against one another. Because as your risks become more defined or more difficult, believe it or not, there is a limited number of insurance markets available that could respond to that risk. So I'm a big advocate of selecting the broker or agent that you trust and then giving them access to the entire market to do the best job for you.
Well, all right. Then let's get a little bit specific. Cybersecurity is obviously in the news. I like cybersecurity as an issue because in a much earlier edition of this program, I sang a pastiche of a song about cybersecurity that made me laugh. Cybersecurity mavens that's the job of the future, Bankers and lawyers, I don't know how many of those are going to have in coming decades. But anyway, so an insurance company, how does it go about getting its arms around the risks, scope of potential damages for a particular business entity when it comes to cybersecurity? It seems dynamic, about as dynamic as it gets these days.
It is, and it's one of those unsettled areas where most brokers would be confident looking at your assets and saying, here's how much umbrella limit you need if there's an auto accident or a slip and fall. Cybersecurity is one of those coverages that is really up in the air for even how much limit is the right amount of limit. The basic underwriting is looking at the exposures the business has. Where's the cyber touch points? Are you handling confidential information? Do you have HIPAA-protected information if you're a healthcare-related entity? Do you have financial-related information? So many cybersecurity underwriters will have an inventory, even use a third party to do an assessment of your cyber exposures and then your cyber controls. With all that said, you're also dependent on those third-party processors that could potentially have gaps, leaks, and even things like dumpster diving. Throwing out old documents in a trash bin could be covered under a cyber policy. So it doesn't just need to be an electronic breach. It could be the old-fashioned paper or information out of a glove box of a car that has got somebody's social security number on it or confidential information, and that would be covered by a cyber policy. So, take the most extreme example. You have a car dealer with somebody's vehicle in for service. They've got some confidential papers in the glove box that aren't secured. That's a cyber exposure that you would never think of. So, insurance-wise, insurance will pay to help remediate the cyber liability. So the required notifications and credit monitoring, there's product out there without a limit. So they will say how many of our customers you have an exposure to. We'll take care of the required notification of those customers. When you start talking about FTC fines and other coverages, you get into a gray area because the whole fundamental insurance of covering fines can run counter to the law. So that becomes a very gray area when a fine could be covered, as well as then loss of business income. So if you think about examples in the news where Target had a massive breach and took hundreds of $1 million write down, it's very questionable today if the cyber policies available would cover that loss of income.
Something you just said about the FTC made me think of something. I'm sorry to interrupt you, but it's something that's been on my mind. I mean, the FTC, you can't really tell necessarily whether the FTC is going to swoop down on your company for a cybersecurity problem. What about the FCPB, the Federal Consumer Protection Bureau, which has been very active in very unpredictable ways, frankly, over the period of its existence? Do insurance policies cover that sort of thing?
Again, those are gray areas where sometimes you can get defense costs, but the actual fines might be against public policy to allow insurance companies to respond.
Meaning that the rationale for the fine is that whoever did it, who's paying, violated public policy.
Right, or a fine is supposed to be punishment, and you shouldn't be able to insure the punishment.
Okay, I'm with you. All right, so with these uncertainties in the cybersecurity context, and I'll ask a more general question, which is a lot of startups these days want to become scalable, or they want to be scalable, meaning that they can get much larger and serve many more customers than they are at the beginning, say by being an internet business or something. And they'd like to gallop toward unicorn status and become $1 billion valuated private company. Okay, so let's say a company is growing quickly. Their insurance has to grow with that, I assume.
It does. I mean, and that's when you talk about cybersecurity and cyber policies, where you have a policy that will respond based on the number of subscribers rather than a dollar limit. Because $1 million when you're a startup company may not be nearly enough as you're growing. So there's definitely ways that you can grow your limit or just have your coverage triggered by some other method. So we have 10,000 clients today, and we'll have coverage on those 10,000 clients. If we have 1 million clients in a year, we still have that same coverage to cover notifications for those 1 million customers without a cap on the limit of coverage.
All right, let's move then from insuring companies to something you mentioned earlier, which is insuring the owner-managers, those who run the company and own the company, or just those who run the company, perhaps just an officer or a director. There might be some unknown unknowns. You mentioned employment-related lawsuits, and I have to congratulate you on your formulation, untoward treatment. I like that. You're getting sued for alleged untoward treatment of an employee. So employment-related lawsuits that allege personal liability on behalf of directors, is that typically part of D&O coverage?
Yeah, so EPL, employment practice liability, and D&O are generally sold as a package because many times it's difficult to separate out. Directors and officers comes into play. Typically, you see the suits when businesses are struggling or whether they're going through bankruptcy or liquidation and somebody's upset. And the interesting thing that the D&O coverages are fairly straightforward. Many corporate documents, LLC, bylaws require directors and officers coverage. But one thing to be very mindful of is for those directors and officers, as the company may be looking to wind down, is that's all claims-made insurance. So the claim has to be made while that policy is in effect. So if that policy lapses, say, for more than 60 days, and they don't buy an extended reporting endorsement, those directors and officers are out of luck. And that's a very large pitfall to watch out for. And frankly, I've seen directors and officers go into their own pockets to pay for that extended reporting period because the entity doesn't have the assets or the receiver refuses to cover that. So claims-made insurance is typically done for the professional liability lines, directors and officers, malpractice types coverage, and other specialized coverage. And claims-made coverage is really an outgrowth of the medical malpractice liability crisis in the late 70s, early 80s, where insurance companies were on the hook forever under an occurrence, so the coverage was triggered by the occurrence of an event. Under claims-made insurance, which has now become the norm for the professional liability, the directors and officers coverage, the claim has to occur during the policy period and has to be made within the policy period or in the extended reporting period. So as long as there's continuity of coverage, the insured is protected. But if they let the coverage lapse, in other words, they don't pay the renewal premium, they don't buy the extended reporting period, there's a big gap for potential.
Let me put a little more meat on those bones. Not all unicorns stay unicorns. Not all companies survive. In fact, some companies fail, and sometimes they fail, leaving people out of the money. Investors with nothing, creditors with claims. If it's claims-made insurance and the period runs out, well, then after the disaster, there might be suits against the director or officer, and that's kind of what you were alluding to. You need to somehow extend that period to protect you in the event things go pear-shaped, which they sometimes do. But I have another issue because I am a commercial bankruptcy lawyer in my other life. And sometimes you get sued on behalf of the company itself. And that results in a kind of insured v. insured issue. Is that an issue that D&O person ought to be aware of and ready to ask about?
Yes, obviously that's the key point of the D&O coverage, where the entity sues the director for mismanagement. And again, most members of boards, public companies, private companies, LLCs, managing members, can benefit by having D&O insurance coverage for that specific type of allegation.
Okay, avoid the coverage from being not applicable because right. The coverage excludes what's called IVI coverage. Now, this comes up in bankruptcy cases sometimes. Well, all right, so these are questions. You have to think about the bad days and think about the growth when you're thinking about insurance, I guess, is one way to summarize what we were just discussing. Well, let's change the tone a little bit. Are there some insurance products that actually enable businesses to grow as distinguished from protecting them from losses?
Definitely, and I really like focusing on my business practice for insurance on those types of insurance policies, coverages, and designs. And I'll give you a couple examples. I've got a close friend and client who has a manufacturing facility, and he wanted to sell a very large load of materials to a steel mill, and he was going to import the raw materials, convert those goods into the finished product and sell it to the steel mill. And he wanted protection because this particular order, while his bank would lend him the money, if they didn't fulfill the order, it would have been pretty catastrophic for his business because the margins were fairly low. So we bought trade credit insurance that would protect the default of that buyer on the order. And as it happens, the cost of the commodity dropped 50% between the time the order was signed and it was delivered. So my friend and client had a huge exposure if that customer didn't take the order. The backstop was trade credit insurance would come in and pay under the policy for that order for refusal to take the order. Typically, they'll pay in bankruptcy, but it will also pay for orders that are just not taken to protect the customers through the chain. So trade credit insurance can be a very valuable tool when you're dealing with a single large customer, when you're putting discipline on extending credit for customers throughout your business, and enabling new markets. So it's very typically used for expanding new markets overseas, for creating discipline around credit extensions for the business, and truly for a backstop for that business if key customers or individual customers go out of business and you're stuck with accounts receivables that you can't collect.
Well, it's a way of riding out volatility in a way. I'm thinking of oil company or oil price fortunes over the last year. Maybe no trade credit would have saved some of these companies because it was so prolonged. But if prices go down drastically and then come back up after a time, well, wouldn't trade credit insurance be a potential way to deal with that eventuality without having to cease shipping or cease receiving?
It is. I mean, there's a fine line between hedging and trade credit. And frankly, I think the capital markets, if you're in a position to hedge, are probably more efficient than trade credit. In other words, the frictional cost of the margin you're going to pay for the insurance policy is going to be more than you would pay for a hedge. But let me give a little more color on trade credit. There's two types of trade credit insurance. One is a multi-buyer policy where you look at all of the credit you're extending for the entire year, and you would have a limit of coverage. So say a small business has at any given point in time $5 million worth of credit extended to various buyers. Now, there could be some large buyers that have a specific limit. Say the top 3 buyers each have $1 million. And then you've got a myriad of small buyers that we would call discretionary buyers that may have, say, up to $100,000 of credit extended. So there's a discipline that policy will impose upon the credit manager of the business or the business owner saying, I can't extend any more credit because my insurance isn't going to cover you. Now, in the event of a loss, those policies typically have a deductible. So maybe there's a $25,000 annual deductible, which is your bad debt number that you can put in your financial statements. Beyond that, if you have losses from bankruptcies or slow pays or unwillingness to pays that are, not in genuine dispute, you can make a claim on your credit insurance policy and typically get 90 cents on the dollar. Then that trade credit insurer will go and fight for that recovery. So it's a very good way to smooth out a business's accounts receivable. So that's multi-buyer trade credit, readily available, although not that used in the United States. Very, very typical in Europe, Australia, other places around the world to drive that discipline. Now contrast that with a single buyer trade creditor, where more the example of my friend and client who had a single large transaction with one buyer, that it was just much larger than they could absorb. So they essentially get that backing of that buyer for that one single deal or that one single buyer. So we've seen a variety of situations where even a service firm, an accounting firm, a cleaning firm, they clean the building for a major tenant. They clean the building for a major group of buildings with a single payer. If that company were to go out of business, they've got huge receivables out there. So we see trade credit applicable really to protect that catastrophic loss for losing a key customer. Now, as the market gets difficult, trade credit becomes difficult. So as sectors get difficult, as you're talking oil, it would be very difficult right now to get trade credit on the oil industry. There's also some retailers today that are very difficult to get trade credit on just because the industry in general is going through a transition. At times in the past, the steel industry was very difficult. Now it's pretty easy to get coverage on the steel industry. So it's a very dynamic insurance in terms of the carriers wanting to stay ahead of the macroeconomic trends in those areas so they don't get stuck with a significant loss.
I imagine customers of the insureds who are seeking coverage are better off doing it in peacetime, so to speak. That is, when the coverage may be available, than waiting for a crisis.
They are, and I guess the other really strong use is if you're applying for a loan or a line from a bank and the major asset of your business's accounts receivables, the banks tend to look much more favorably on insured receivables versus uninsured receivables. So they may give you better terms, they may give you larger lines of credits or larger loans. So it works part and parcel with the bank application process.
When you were talking about single trade creditor insurance, I'm not going to name any names, but there's a well-capitalized retailer out there that is not in trouble or anywhere close to it, who's known to play serious hardball. So if that's your main customer and you're worried that they might say, you're going to do it our way or it's the highway, they might hit the highway. And so to insure against that, you might purchase single buyer trade creditor insurance, I would think, if you're worried about that exposure.
And the other thing is there's so much opportunity for small business to do exporting around the world. It's very difficult to get credit information from foreign buyers. And many of the trade credit companies are international, and they will be able to essentially stand behind those foreign buyers. So it can simplify the process of becoming an exporter.
And then pursue the receivable if they pay on the claim with their greater resources and abilities with regard to pursuing international collections. All right. So then let's talk a little bit about IP before we close. You are, I think, a casualty guy, among other things. Think of fire, floods, frogs, locusts, destroying tangible property. What sorts of threats loom for intangible property, and which goes beyond what many people think about, could include customer lists and trade secrets? What sorts of threats loom for that a business owner should be made aware of and probably make sure that considers insurance for?
Sure. I think the area of trademarks and patents is less insured. The market is emerging for patent defense coverage, patent enforcement coverage. There's basically two types of patent insurance available. I recently worked with a small company, basically a one-room manufacturing firm that had a great product. They had a patent they put out there, but they were very concerned that the behemoths in their industry could basically ignore their patent, come in on, stomp on their product, knock it off, and sell it for a lot cheaper. We help them buy insurance that would allow them to enforce their patent. And the thought being that that large company can win the war of attrition because they've got the resources, thinking that the small manufacturer with the legitimate patent won't put the fight up. So the insurance actually pays to fight to enforce that patent. And it goes so far as that the insurer writing the coverage wants to advertise the fact that their customer has insurance. In other words, it's like having an alarm system on your house. Here's a big sign. If you come after us, we've got this great big insurance company that's going to come after you. And it's a really interesting way to enable that legitimate patent holder to be able to maintain their intellectual property. The other side of that is what happens if that small manufacturer accidentally, unintentionally, let's say, stomps on somebody else's patent and becomes the party to the other side of the equation. So there's insurance for that as well. And those are typically done for multiple years. They can renew and could be starting at $250,000, which doesn't go very far in defending a patent, up to the millions of dollars. The process is a basic patent search by the underwriter to look at the actual patent, and they'll do search to see if there's other types of inventions or patents that might be making things more difficult to enforce. But the product is really designed to safeguard that intellectual capital and give you the resources to fight the fight if you have to.
I guess when you were talking about patent coverage, which permits a small company to have the resources to defend its own patents and thereby compete on a more even playing field with the big boys, I was thinking of My Bodyguard, an ancient movie where a small kid had a big kid help him against the other big kids. That also struck me as a form of insurance that enables business as opposed or is distinguished from one protecting businesses from losses, as we discussed earlier.
Exactly.
But patents are easier than other forms of intellectual property, I think, because they're easier to identify. After all, they're public. And the law regarding how to defend patents might not be totally settled, but it's voluminous. Whereas I would think I guess my question is big data going to make it easier to write similar policies for trade secrets or the other forms of intellectual property?
If you've done any study of Bitcoin, the concept of blockchain technology is emerging very quickly in the insurance world. And basically, their cybersecurity and patent and trademark to some extent, all those exposures could totally be eliminated by blockchain technology. It's interesting because it allows that value of ownership to be placed on multiple servers around the world, simultaneously verifying who owns what. And I see that as an emerging trend in insurance. Frankly, I'd love to try to find a way to harness it, but I think so many of the risks that we talk about might disappear from some of these technologies.
That's a rather momentous statement, and I'd like to end on that momentous statement and making a mental note to get that blockchain guy or gal on here, which I'm meaning to do. Dan Rossen, JDCPCU of CRC. Thank you very much for your insights today.
Thank you.
You've been listening to Financial Poise Radio, which is a property of Financial Poise. Please go to www.financialpoise.com for more information of this kind and to find an enlarged biography of Mr. Rossen. Financial Poise Radio is produced by Stephanie Strait. We thank you all for listening. Let's do it again sometime.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.financialpoise.com. Each week, Financial Poise Radio brings you news and education about finance, investing, business, and law. To see a short written summary of this episode, go to www.financialpoise.com. Financial Poise Radio is a production of Financial Poise Radio Productions, LLC.